Cool.
All right. So on Reddit, I made a really quick search about covered calls. And the third suggested search was selling covered calls for income. So, Kris, here is my master plan. I'm going to buy shares of a stock that I like, and then I'm going to sell calls against the shares that I own, and I'm going to collect income off of those shares and probably get super rich and not have to do any work. So let me know if you're ready to sign up with me or what you think of that.
Income for nothing sounds pretty awesome to me. I don't quite think that's how it works. Um,
So,
let me give
so
you an
when you,
example. Let's,
yeah, so when
oh,
you
go ahead, go
think,
ahead.
yeah. So when you say you don't think that's how that works, when I sell a call, I collect a credit. That's my income.
You you do. Well, you collect some premium. You collect some premium, first of all. Okay. Let's say let's say that let's say that a stock is $100 and God tells you that there is a 10% chance that the stock is going to go to $200. Like you know that this is true. 10% chance going to go to $200. And you can sell the one you go and you sell the 150 strike call for $2. Okay? You have collected premium up front, but I would not think that you collected any income. Because if that call, it's worth, well, 90% of the time it's going to be worthless. But 10% of the time that call is $50 in the money. So 10% of the time it's going to be worth 50, which means its expected value is $5. So if you sold it for $2, I would argue that you have actually created negative income of $3, but you have collected $2 of premium.
What if I am of the opinion that I don't care about value maxing? I just care about collecting some sort of credit on shares that I own. So in the scenario that you gave, I objectively would not be value maxing, but I still would be collecting some sort of money on an asset I would hold anyways. What's the downside there?
Well, the downside there is that you have to think about this as you're not just going to do one trade in your life. You have to think about it as a repeated game, right? So the way to think about the example I just gave is let's say you're going to do this 10 times on ten different occasions. And nine times out of 10, like I said, those calls are worthless. So nine times out of 10, you're going to collect your $2. So you're going to make $18 nine times, the sum of this $2 nine times. One time you're going to lose $48 because you sold it for two and you lost 48 because it's going to be worth $50. So if you play the game 10 times, you make $18, but you lose $48. So you've lost $30 over this entire experiment of selling these calls. You've lost $30 playing a game 10 times, which means you lost $3 per game, which is exactly what we would have predicted if you sold a call that was worth $5 for $2. So even though you made $2 you could have made $2 five times in a row, and you would be sitting there thinking you're a genius. But the full probability of what's happening here is that you are going to be losing money. So in expectancy. So what we're saying is that it's exactly the same position as being a casino, being on the wrong side of the casino, right? On any one attempt at the casino, they don't care if they win or lose. They know that they have the advantage sort of over the long run. So, and honestly, in this case, selling this call, collecting this premium of $2 when it's really worth $5 is a lot worse than, blackjack odds or roulette odds. I mean, you're better off going to the win.
And so another follow-on point that somebody could debate would be, well, implied volatility typically is overstated against realized vol. So in that scenario, if we're collecting two, it's worth five, obviously we're like grossly off. But what if it's not the case? What if the general trait is true that vol is slightly overpriced, even though we're talking about the call side, which that's more unique to individual names and, little rabbit hole there. But let's just say it's closer to parity.
Yeah, that's so I would say that in that case, you might be making money. You might be making edge, and you might very well be the side of the casino in that example. But I don't think you can call, let's say in this case, you sold the call for $6 instead of $5. So you do have edge here. You're selling something for $1 more than it's worth. So in this case, you've collected $6 in premium. Now, if you know that the call is worth $5, then I would say that you've booked $1 in a theoretical profit. You've booked one, maybe you could theoretical income, maybe you could call it. But you couldn't call the entire premium that because a lot of that premium is just compensation for the liability that you have, which is you have market risk. So in that, even in that case, and that's how a market maker, by the way, would think of this, is in their books, they have some notion of, P&L to Theo. So in their books, they're going to say, this is worth $5. I sold it for $1. I made $6. I made $1 of profit. So in that case, I think that you can book it as an economic profit, but you have to understand it's theoretical. And the rest of that premium, the rest of that $5 is an asset you basically have in reserve against the liability that you could lose on this.
And I think this opens up an interesting part of the conversation because it really highlights how dumb I am compared to somebody like you. Because when I hear that, I'm just so simplistic with it. I immediately think if you sell an option, you collect a premium, sure, you are holding money in your cash and sweep that's now still tied to an open trade. And I think that in and of itself makes the whole argument for income really difficult to wager, because even if I collect a premium, I still have an open trade that I need to reconcile. And let's say that we're in a smaller account and I don't have excess cash in my cash and sweep. But let's say that I need to close that trade down because it's a loser, it gets challenged, it's in the money. My idea is I need to roll it out. Now what? Now I need to add money to it doesn't just appear out of nowhere. Now you might be able to submit an actual roll order if you can get a credit and your broker might allow that. But I think the broader point is that, and the real danger here for people is if you think that the premium you're collecting and you treat it as income, just like you got from a W-2, well, when I get paid from a W-2, that money's mine. Now the government already had their slash on it and it's now mine. I could do whatever with it. It's not tied to anything. But it's completely different with a trade. So I want to address and kind of pontificate with you a little bit about the psychological element of this, because I find it's interesting. Because in the context of trading, like we were talking about just before we recorded, I'm of the belief that any sort of realized trade, if you were so inclined to call that income, then whatever, call it income. It's like P&L is realized P&L is realized P&L. You feel like calling it income profit at that point because you're going to withdraw it, whatever. But the bigger issue, I think, is like the psychological underpinning of trying to consider something for income. So what are your thoughts on this? I looked on Reddit, there are no shortage of people who are absolutely convinced that their covered call approach is really benefiting them and it's helping them be profitable long-term because exactly as your scenario outlined, they're seeing a bunch of winning trades. What are your thoughts on that kind of mentality and how it impacts the trader longer term?
So I think it's easy. I don't want to say that people are fooling themselves, but I just want to say that it's easy to fool yourself. And I'll give an example of why. If you sell, let's say you sell a 25 delta call, which is like a call that is a little bit out of the money. Let's just to make numbers on it, like it's $100 stock and you sell the 110 call, let's say. So the way to evaluate if that worked out for you or not is to say, well, what I have done when I sell a 25 delta call, it is mathematically the same as saying I sold 25% of my position. And so one thing that we can do is say, well, how would I perform in different scenarios if instead of selling the call, I had sold 25% of my position? That would be an apples to apples comparison of, hey, is selling calls a good idea or not? And we know, well, here's the situation. If you sell a call instead of selling 25% of your position, when are you happy and when are you sad? So think of it this way. If the stock goes to zero, then you will have wished you sold 25% of your position instead of just selling your call. Likewise, let's say that $100 stock goes to 200 bucks. Same thing. You're going to wish that you would have sold 25% of your position rather than having your entire position get called away from you at 110. So what you notice there is you are always sad when the stock makes a very large move in either direction. And you're happy if the stock really doesn't make a large move in any direction. If it goes from 100 to 110, you're pretty happy. If it goes from 100, even drops to 95, you're better off. You could have been better off selling the call rather than selling your shares. So uh, in this case, small movements, you're happy that you sold the option, and large movements, you're sad that you sold the option, which just tells you you're just short volatility. You just don't want the thing to move. So regardless of whether it's a call or a put, you are just sad if the stock makes a large move in either direction versus the other strategy that you could have taken, which is just selling 25% of your shares. So I think if you compare your performance to the right counterfactual, the right what I would have done if I had not done this, you will see that you will just see that it just depends on how much the stock moves. And then that's basically now you're starting to really understand options at that point.
There's an irony there too, because if you think of a covered call where the max profit is, it's above your short strike. But exactly as you're highlighting, a lot of times that's where somebody's unhappy because now they're having to unwind their inventory. It's almost like people get so obsessed with the short call part of the trade that they forget that like the entire base of that trade is long equity. That's really how you're trying to make money. If you're trading something like a covered call, at least in a stock that you like to own in that more stereotypical fashion. And it leads to another follow-on that's kind of not something people like to talk about. Two things. One part of that is the fact that if you look at most covered call funds and, they have like the systematic covered call on S&P and things like that, they typically underperform. And a big part of that is because the underlying actually spends, if it's a good underlying that you actually want to hold equity in, a lot of times it spends most of its time going up. And it leads to this natural conflict. And one of the things that I view to fix this problem partially, and one of the things that I like to do in a strategy that I use called a covered strangle, which is more for like a longer term campaign and something that I want to hold, is not just being thoughtful on when and where selling short calls, but selling them at a ratio. So if you have 500 long shares, it's not selling 5 calls. It might be selling 2 or 3. If you're trying to collect some sort of premium on the thing that you're holding longer term anyways. If you were to fix the idea of like selling a covered call for income, if you were to apply corrective action on that, what would you do?
So what I would do was two things. One is sort of goes back to a little bit of a behavioral thing, which is to say, well, why do you own the stock in the first place? So when I think about single stocks, like most of my own investing is like I'm invested in indices because I'm just getting a diversification cheaply. But if you look at the history of single stocks, I don't have the stats in front of me, but like most single stocks many single stocks that have ever been in existence are not in existence anymore. Like lots of companies eventually go bankrupt. And the overall performance of the market comes from the fact that some stocks have made astronomical returns over a very long period of time, and then the index rebalances it. But if you think of something like Amazon, for every Amazon, there's 10 pets.com. So the reason to own a stock is for the massive, crazy right tail upside. Otherwise, just own the index. So I just don't fully understand why you'd want to sell calls on a single stock when the whole point of owning the single stock is that you are in it for the right tail. And here you're explicitly saying, here, take the right tail. So that's kind of one way I would think about it behaviorally. The other aspect of thinking about selling calls that I would like to improve is just the idea of actually understanding like, is this volatility high? Is it low? I mean, if you think about, you mentioned the covered call funds, their big problem is that everybody sees them coming because they're not economic, right? They're just, hey, our rule is that we go and we sell these calls. And so, well, if I know you're going to sell the calls in a week, I'm going to bid lower for them. So you're not going to get a very good price on the calls. So uh, the big problem there is that they are non-economic actors. They are not actually looking and being like, is this a good call to sell? They are just selling those calls because that's their rule. So if you are an individual selling calls, then I would say instead of just blindly selling calls because you read somewhere that selling calls takes in quote unquote income, I think you need to do some analysis to be like, is this a good call to sell and why? Have reasons for it. And once you start thinking like that, now you have a way to be able to evaluate yourself afterwards. You can say, hey, I went and I studied this and I thought these were a good sale. And you may win or you may lose to it. And you might, but you could look afterwards and be able to make statements about, well, what did I do wrong? And that is how you learn. And learning is the whole key to this. It's like the more you're going to learn, you now have a framework for learning. But when you just do things blindly because somebody told me selling these things for income works, you have divorced yourself from any ability to learn because you don't really know the why.
And you keyed on something that I think bears double clicking into, because I think if we look at this realistically, the probability of people now magically not selling covered calls is about zero. It's going to happen. So if we were to brainstorm some of the metrics that we might think are good sales for a covered call, what are some of the metrics that you think are most relevant there?
So I do think it's important to look at things like the implied volatility versus the realized volatility to understand, like, am I actually selling a premium volatility? You have to be a little careful because the implied volatility that occurs on calls oftentimes can be cheaper than the implied volatility that happens at the money. So sometimes those vols they really are cheap because lots of people like to sell calls. So one would be the implied volatility versus the realized volatility. And the other one is also just understanding what is coming up. For example, a call might look expensive just because the stock has earnings coming up. But you haven't done any analysis there to be like, is this call net of earnings priced properly? Earnings for some stocks, like Robinhood just had earnings, and I was kind of looking at that, and I noticed that the earnings move was priced to be somewhere around 9% beforehand. So this is a situation where the stock is going to make a large move, or the market expects the stock to make a large move. If the last four earnings, Robinhood has moved 9 or 10%, and this earnings, it's being priced to move only 5%. Like the calls are not that expensive. You would like to know that before you went and sold those calls that, these calls look a little bit more expensive than normal, but they're really cheap compared to the last four earnings. So again, it's sort of asking you to say, let me look at this thing and be like, does it make sense? Does this price make sense compared to what I know about the stock?
Another thing I would add to that is when people are doing some sort of analysis of like IV against realized vol. I also find people don't take the time to match the terms that they're operating in. Because a lot of times people will just use the vol for the underlying, right, which is 30-day vol. And they might be selling something that's 50 days or 20 days. And there can be pretty stark deviations once you get into those terms compared to 30-day vols. If you were to think about like some of the quote unquote sweet spots to look at selling covered calls, what kind of time frame would you naturally default to, understanding it's going to be a range? And what kind of deltas would you naturally gravitate towards?
So I would, first of all, as far as deltas, I would gravitate more towards sort of meatier deltas, things that are um, like more in that like 25 to 30 delta range, not like 5 delta. Like you don't want to be selling these really skinny options that you're collecting very little up front, and you will be really sad if they hit. Basically, the risk reward on those is pretty bad on selling those. And then the other thing I would look at is just understanding it's less than what I would look at than saying, hey, if I sell an option that is has 2 weeks to expiration, I'm just trading how much this thing can move. If I trade an option that is has 1 year until expiration, I'm now trading, there's an implied volatility component to it, right? Because that option is going to be really sensitive to what happens to the volatility, it going up or down. And it won't be that sensitive to how much we're moving around today. I mean, if you sell a 1 year call on something that's 20% out of the money and the stock makes a 5% move today, it's not going to make that much of a difference on the value of that call that's a year out in time necessarily. But if all of a sudden all the volatilities in the world double, that option is going to double in value. Like if we have a liberation day, that 1 year option is going to explode in value. But if you had a 2 week option, yeah, the option will go up in value, but the risk is off your books in 2 weeks. So you're not kind of stuck in this like really bad mark to market situation. But the point of it is that if you trade a near dated option, you're trading how much the stock is going to wiggle. And if you trade a long dated option, you're trading this more abstract thing called volatility. And if you decide to sell covered calls on shorter dated options, now you're probably in this thing where you're doing it more often, right? If you sell options quarterly, you're probably selling options 4 times a year versus if you sell an option just 1 year out. You'll collect more, by the way, over time. If you the premium amount, I should say, will be more if you sell every 3 months than if you just sell one time in 1 year. But that gets
Definitely.
into some weird reasons.
Yeah, definitely. And so then to get a little more zoomed in, thinking about the balance between theta that you might collect holding over duration and then the gamma you want to expose yourself to. Is there any sort of ratio or relationship between those that you've found to behave well, likely within a smaller universe that's not like a generalizable rule, but anything between theta and gamma that you found that might be useful for an option seller, specifically in the context of cover calls?
Well, I would say that the thing about theta and gamma that's really interesting is so there's a couple things to just understand about them. One is that the lower the volatility is, the more gamma the option will naturally have. So, and that makes sense. If you sell a call on something that is 100 vol, well, a $1 move in something that's 100 vol just doesn't mean that much. It's already 100 vol. But if you sell an option on something that's only 10 vol, that $1 move, if it's a 2% of the stock or 1% of the stock, that's a significant percentage of that's a significant move. So number one is a low volatility means that you are exposing yourself to a lot of short gamma, and you're not getting paid very much theta for that. Likewise, the high volatility option you will not be short that much gamma, but more you'll collect more theta. But that's not some kind of a free lunch. It's just recognizing the fact that the high volatility stock is just going to move a lot more. So that's the first thing, is just understanding that low volatility stocks don't have that much theta in their options relative to high volatility stocks. Um, and then the other thing to realize is that um, so if you have a very high vol option, it's just recognizing that it could be high for a good reason. So if we look right now, I don't know how many people out there want to go out there and sell covered calls on oil, but I think the call skew is high for a reason right now. We're a little bit. I was just looking on Polymarket today, and there's a 62% chance, according to Polymarket, that we're going to strike Iran before the end of March. So those oil calls are priced. They look expensive if you're just looking at the price of oil calls, but without that missing piece of information that we're likely to attack Iran, uh, then it's very justified that the calls would be very expensive. So I think just recognizing that there's not a bunch of free lunches sitting everywhere. So if the implied vol is high, it's usually high for a reason.
Another thing that I found specific to individual asset classes and industries, and it's definitely like if you are the kind of person that has a portfolio of long equity and you like selling calls for whatever reason, it's definitely worth your time to track how fairly priced the vols seem compared to something like an implied volatility percentile. I prefer that over like implied volatility rank personally. It's just a little less skew prone. But one of the things that you'll note is that, and I also had a conversation with Ewan Sinclair about this, which he kind of corroborated some of what I was seeing, which is in a lot of assets is like things like implied volatility percentile start to get like near extremes, like 90% plus. A lot of times you'll actually find that vol is closer to fairly priced than not. And it's obviously hyper specific to regime and the underlyings themselves. But to your broader point of there not being just this free lunch, because that's what a lot of people will do. They will sort stocks by high implied volatility rank or percentile and just go sell call on those because they think they're making more money. And there's another thing, part of this thesis, one layer down for people that are a little more seasoned, but still don't know what they don't know, which is they will think that they're trading mean reversion of volatility. So if implied volatility percentile is high, their thesis is now, well, it has to come back down. Obviously, this foregoes every conversation about clustering and stuff like that. So if you were to explore that part of the thesis specifically, the person that says, I'm going to sell covered calls in high IVP IVR because I believe I'm going to, capitalize on mean reversion of vol. What do you think about that?
Yeah. So first of all, if you thought if you're not trading, when you trade implied vol, you're not trading this line on a chart called implied vol that goes up and down. If you were, you should just sell implied vol before earnings, because I can predict with 100% certainty that the implied vol the day after earnings is going to be lower than it was the prior day. There's no mystery about this. Everybody knows that. The issue is that your P&L is derived from how much we're going to move. So there's no line on a chart called how much are we going to move. It's like we're either going to move a bunch, we're going to move the whole straddle and more or not. And that is going to determine the result of your P&L, not this magical IV number that you've been tracking on a chart. So first of all, when you trade an option, you're not trading implied vol. You're trading some combination of how much is this thing going to move and the implied vol. And the shorter dated you trade, the less you're trading the implied vol number, and the more you're just trading how much is this thing going to move. As a matter of fact, I oftentimes don't even think about vol when it on a near dated option at all and only think in terms of straddle prices. Like, what is this straddle price? Does this straddle price make sense? Instead of thinking about it in terms of implied vol. The other thing I would say about implied vol, which is interesting, you kind of said about when implied vols get really high. I think about this as, let's think about the opposite for a second. When the S&P is barely moving around, like let's say it's moving at like a 6% vol, it's moving like whatever, 20 bips a day or something like that. The implied vol when will not go down to six. It might go down to like eight or nine. So the implied vol does not go down as far as the realized. And that's because people expect mean reversion. Nobody expects if you told me today that I could buy implied vol for 1 year in the S&P for six, I would go borrow money from everybody that I know and buy as much as I could of it, right? But implied vol is never going to get that low just because the realized got that low because the market is forward looking. Well, the same thing is true. The same thing is true when vol gets really, really high. So actually, a great example was silver uh, in this last couple of months. So I was looking at like the 1 month realized vol in silver was about 130%. The crazy thing about that is that means that there is no volatility you could have sold in the last month that was a winner
Can
because the
confirm.
implied vol never got there, right? So I've experienced the same exact thing before in natural gas. I've traded natural gas for a lot of my adult life, and I've had times where I've looked back and said there was not a single implied vol that you could have sold that ever was profitable. And that's because the market's always forward looking. It says, hey, we're realizing, 130, but that can't keep up, can it? That's not going to happen. That's not going to continue. And the market will price it at like 115. So you go and you sell 115 vol, and then the market goes and realizes 130 or even more, and the implied vol never really goes up. So you'd think you'd be happy, but you're not happy because the realized vol is chopping you to bits. So at the extremes, the implied vol never really gets to the extremes of what realized vol can do. And that's exactly why Ewan is recognizing that when the implied vol gets to a really high number, uh, that doesn't mean it's a sale. I used to have a joke at work that, when you do your sorts, you buy the highest one and sell the second highest, was just a joke that's acknowledging this idea that whatever the highest vol is on the board is probably not high enough.
It's really comical as well because I think it conflates for a lot of people like what you were talking about before, what they're actually trading and what their actual P&L is constructed of. And the longer term impact of that, I always think of it in terms of like the process, right? Like what decisions are we making in this process and how does that yield longer term? So if you were thinking in the context of covered calls and you were thinking of trying to build an approach that in the long run actually outperformed just holding the underlying over the same duration itself, do you think it's possible? And what kind of structure approach would you use for that?
So I would think that I tend to think about things in terms of like where's the risk premium. So I would think that generally selling calls probably doesn't have you probably there's I guess the question would be why would there be a risk premium to earn from selling calls if everybody wants to sell calls? So when would there be a risk premium to the calls? It could be situations like when the market is coming for the calls, like when people want to buy them. I mean, this happens, and we had it was in late 21 when SoftBank, Mayoshi's son, was coming in and he was lifting all these calls in all these tech stocks, and the call skews went nuclear. The option balls were super jacked because you had this big buyer come in. And yes, if you would have gotten smoked if you sold them the calls when he first started buying, but that's true of any ever trying to trade against somebody at the start of a giant order. But over time that would make sense for a situation where like, hey, there's starting to be a risk premium to this. The market is begging you to sell these calls. Whereas in a normal situation, the the market is not the market is the market makers are buying the calls. It's like because their job there is to be the supply, right? The market, you always have to think about what the market wants. So if everybody is a seller of calls, then the market is bidding for buyers of calls. The market needs to offer a risk premium to people who want to buy them. So likewise, when they get super bid, that's when there's a premium for coming to sell them. Like in oil right now, the risky side of the trade, the hard side of the trade is selling the calls. But that probably is the side with the risk premium in it, unfortunately. But that's how making money works. It's doing the hard leg. So uh, I think that over time, if you're trading in the direction of where the risk premium is, you would be more likely to make money.
So if we think about like as a overarching view then of this thing of covered calls for income, it seems like we're generally agreed that one, it doesn't really work the way that people think it does, that in order for something like that to be applied thoughtfully, there's a handful of things that people need to look at. If you were to summarize all of that out and to think of a way of fixing selling covered calls for income, what does that look like?
Yeah, I would say that it's just the idea that covered call options, call premiums are not free money. So you have to subject them to the same thing you would do with any decision about trying to make a profit, which is, hey, why are these a sale? I think at the end of the day, it's just moving people from doing this thing blindly to being able to say, why are these a sale? And for example, if they're going to sell options in XYZ, I would say, well, why do you like them in XYZ and not in ABC? Like, why are you selling Apple calls instead of Tesla calls or vice versa? And the point of that is not because I'm sitting here having an opinion on Apple or Tesla. It's just to force the person to focus on why they're making this decision and that the decision is not falling back to something along the lines of, well, I read that selling calls makes me free money. Because if that's the case, why don't you just do it on everything? Why did you pick even the thing that you chose? So I would say ultimately it's not about saying that selling options is bad as with a blanket statement any more than we're saying selling options is good as a blanket statement. The point is that there's an analysis that should be done. And if you start to try to do analysis, you now have a way of learning from what you're doing. And so I'm just pushing people towards do analysis to understand what you're to understand why you're doing this thing and not just accept that there is an edge in doing the thing.
So if I were to throw out a TLDR for that and package that up in a simple way for people, selling calls for income kind of is a busted statement at face value, but selling calls in and of itself can be done thoughtfully. And in order to do that, you have to analyze the opportunity as it is versus some sort of, selection of I'm just going to sell calls against this and continue to do that because of the example you gave earlier, where in the long run, that can actually lead to negative EV, depending on how the thing moves. Is there any other bit that you would add to that?
No, it's really, I think you nailed it. I'm just urging people to think about what would go into the decision that this call is worth selling or not worth selling. And that once you start thinking about that question, well, then there's the whole rabbit hole that we can go down. But until you realize that the blanket statement is just doesn't really work. I mean, if that blanket statement worked, then why wouldn't all the hedge funds in the world just be out there just bombing calls and making great returns for their investors. They don't do that because it's not obvious that blanket statement is true.
Makes sense to me. Hopefully it gets people to think about things a little bit differently. And as you guys know, we are here to try and offer a slightly more nuanced perspective on a lot of these things. So we will see you guys on the next one.